All right, let's get right into this explainer on ARM. Look, if you're watching this on a smartphone right now, there's a 99% chance ARM is powering it. We all know they dominate mobile, right? But what's happening right now with this company in data centers and AI? Well, it's honestly one of the most massive structural shifts we've ever seen in the history of computing. So let's unpack their financial trajectory and see exactly how they're dominating the AI revolution.
To do this, we're going to systematically break things down into 6 quick pillars. We'll look at their IP business model, that expanding economic moat, how they stack up against the competition, their current market share, the massive TAM expansion projected into 2031, and finally, we'll dive into the actual valuation metrics to see what this all means for the stock.
Starting off with Pillar 1, ARM's IP business model. To really grasp why their valuation has just skyrocketed, you've got to understand their incredibly profitable asset-light setup. Because believe it or not, they don't actually manufacture the physical chips you hold in your hand.
Instead, you should really think of ARM as the master architect of a skyscraper. They aren't out there pouring the concrete or buying multi-billion-dollar construction equipment like Intel or TSMC. No, they just draw the brilliant blueprints, the instruction set architectures that literally everyone else relies on. By doing this, they spread their fixed R&D costs across billions and billions of shipped units. It creates a cost structure that basically no single custom chip designer could ever match on their own.
And that brings us to their dual revenue stream. It's a fantastic one-two punch. On one side, you've got licensing revenue. These are the huge upfront fees companies pay just to access ARM's blueprints and their new compute subsystems. But then, on the flip side, you have royalty revenue. Once those chips actually hit mass production, ARM collects a recurring fee for every single unit shipped. And what's wild is that right now, ARM is transitioning the whole industry over to its newer architectures, which is effectively doubling and sometimes even tripling their royalty rates per device. This combo, it's exactly why they boast gross margins nearing a staggering 98%, which, if you follow hardware, you know is practically unheard of.
Moving to Pillar 2, the expanding economic moat. Let's look at how this business model essentially builds an impenetrable fortress around their cash flow.
So ARM actually boasts a wide economic moat, with a really formidable score of 9.2 out of 10. But here's the crucial part. This moat isn't just stable, it is rapidly expanding. They aren't just resting on their laurels with that mobile monopoly. They are actively widening the trench, so to speak, by locking in much higher value compute markets.
You might be wondering, why is it so incredibly hard to compete with them? Well, it comes down to immense switching costs. Moving away from ARM to an alternative architecture requires a level of financial and engineering investment that most companies literally cannot afford. It's a classic network effect. Hardware designers go where the software is, and millions of software developers build for the hardware. Add in decades of deep R&D that's yielded thousands of foundational patents, and you get a lock-in that's nearly impossible to break.
All right, on to Section 3, crushing the competition. Let's stack ARM directly up against its top semiconductor and IP rivals to see who's really winning the arms race.
When you look at this comparison, the divergence is pretty clear. Legacy players like Intel are facing an eroding, narrow moat, really feeling the pressure from high capital intensity. But ARM? They're standing alone with a monopolistic foundation and advantages that just keep expanding. Now sure, highly successful companies like Synopsys or Cadence definitely have stable, wide moats, but they aren't expanding at the explosive rate of ARM's current AI tailwinds. And while AMD is making some really great strides, they're still kind of constrained by older ecosystems. ARM is simply offering unmatched power efficiency right when power has become the absolute most valuable commodity in computing.
That brings us to Pillar 4, the current market share breakdown. What's truly fascinating here is how ARM is taking that defensive moat we just talked about and using it to aggressively play offense far beyond mobile phones.
We already know their mobile dominance is legendary at over 99%, but look at this diversification. They now command 50% of the IoT and embedded market, plus 44% in automotive. But the real jaw-dropper, the data center. Their footprint in data centers has quietly surged to capture roughly 45 to 47% of all infrastructure revenue. Why? Because ARM CPUs are being heavily paired with those premium, high-value AI GPUs to maximize efficiency.
To put this into perspective, every time you use a cloud service from AWS or Google, you are increasingly running on ARM's custom designs, not traditional x86 chips. As these massive cloud giants push to design their own custom silicon to drive down costs, ARM's architectural share among hyperscalers is actually poised to hit a staggering 50%.
Let's pivot to Section 5, TAM expansion into 2031.
we need to look at the incredible runway ahead and the huge total addressable market ARM is preparing to conquer.
Driven completely by the AI boom, ARM's total addressable market is projected to basically triple, going from $535 billion in 2026 to over $1.5 trillion by 2031. Just look at cloud AI. That segment alone is jumping from $245 billion to over $1 trillion. Edge AI and physical AI are also modeling massive outward growth from their $250 billion and $50 billion baselines. And here's the so what of it all. As AI evolves from just answering chat prompts to autonomous agents running continuous 24/7 workflows, the computing bottleneck shifts directly to the CPU that has to orchestrate all that data. For ARM, that acts as a massive volume multiplier for their per-core royalty model.
Finally, Section 6, Valuation Metrics and Outlook. Because with all these massive tailwinds, we have to take an objective look at how Wall Street is actually pricing the stock today.
So it's a bit of a double-edged sword. On one hand, you have this virtually flawless 97.5% gross margin, a solid 13.4% return on equity, and incredible liquidity with a current ratio over 5. It's pristine. But on the other hand, investors have to stomach a sky-high forward price-to-earnings ratio of over 112x. The market is pricing ARM as the foundational layer of the entire AI economy, which essentially means they're demanding perfect execution to justify these kinds of multiples.
Which leads us to the ultimate question. Given its impenetrable expanding economic moat and these massive tailwinds from the AI revolution, you really have to ask yourself, does ARM's flawless execution justify a monumental valuation premium? Are we looking at a stock that's simply priced for an impossible level of perfection, or are we looking at the foundational toll booth for the next decade of human computing? What do you think?